All right, so I'm recording it now. All right, so good afternoon, you all, and welcome. This is our third session, and as before, I would be recording it. And if you remember, last week we had two sessions, Friday and Saturday, and I uploaded the YouTube videos in the system. I try not to make them lengthy so that sometimes I forget to take the pause. So I only record the things which are meaningful to you, today we have topic 3 that we shall discuss. And the name of this topic is financing new ventures. It's very much in line with your in line with the course title itself. Now, my plan is that today, after we finish it, if the time allows me, I would be discussing with some of the contents of the finance plan. Finance plan, even for a small company or a new venture or even a newborn company, could range from 2 pages to 20 pages. Okay, so there is no limit. But I tried to be a little bit prescriptive, and I gave you some contents in the example finance plan. And my plan is that tomorrow's session, I shall be discussing with you almost everything which directly goes with your finance plan. So there would be some topics which I shall discuss with you, and you might use them in your finance plan. Financing new ventures. Well, financing is very important. Financing, if you remember, last time when we met, we had some discussion that if I have to split, if I have to decompose a company into some segments, I would be able to see 3 segments of the company. The one is financing. The other one is investing. And in between this black box is operations. Financing is money comes from. It shows the sources of money. Investing is money goes to. So primarily, your financing appears on the liability side of a company. In this course, especially tomorrow, I will take you to the real life example. Remember, I would assume that you are a newborn company and you don't have any historic data. So in that case, you have to benchmark yourself with some established company. Let's say you want to start you can see this thing in your example or the instructions for the finance plan, that you start a business with 100,000 euros, right? Now you decide which business or which sector or which industry you are planning to venture in. Now, because you don't have any historic data, and if you want to go for the subsequent changes in your financial structure, you need some more money, you need to go with some numbers. Well, you don't have numbers. In that case, it's nice to have a selection of some legend companies in your industry who you think you can benchmark against, right? These number of companies could range from 5 to any number. Like, as I mentioned last week, that in one of our project, our students benchmarked against 15 companies. All right. Now, benchmarking yourself in the real life against 15 companies is understandable. But because this is a course, I don't want you to do the same thing for 15 companies. So even though in practice, if I'm a funder and I'm seeing your comparative company-based analysis, I will not accept anything below 5. But because it's a course, I would assume that what you do with one company, you do with the 5 companies. So for this course, you can benchmark against one legend company is enough, right? So because it's only a prototype, it's only a practice. So for the purpose, it's not a bad idea that you can find a single benchmark company, the industry, the business you want to venture in, okay? So tomorrow we shall discuss how the company's balance sheet looks like. Well, some of you know already, the assets and liabilities. And then we shall do some ratio analysis, all right? Then we shall do some market analysis of the company, that how your benchmark company is performing in the stock market. So if somebody asks you, hey, can you give some estimate of your potential market value? Then you can benchmark against the legend company, and then you can resize yourself. And then you can say, okay, fine, if this company, which is a multinational asset base is this much, a couple of $1 billion, if that company's market value is this, then I can make some kind of conjecture that if we become public company suddenly, or if we have to sell ourselves in the market, how much will be worth of. So you will be doing the market analysis as well. Yes. Yeah. So you just have to do the calculation for a big company, a legend company, and then you need to scale down to 100,000. In many cases, you don't even have to scale down, because when you do the ratio analysis, ratio or size, there is no size, no size matters then. Yeah, so it's only coefficient. But for example, if you want to check your market cap, potential market cap, or the potential book value of the company, in that case, you might have to resize yourself. Ratio analysis you will be doing for the accounting analysis, the financial analysis, and then you will be doing the market analysis. And the third thing, which I think I should have mentioned, but I didn't, since you are showing this thing to your bank manager, the potential funder, that, hey, how much you are valuable, how much return you are likely to produce. What if he asks you, hey, do you have any idea how much risk you will be exposed to? You get my point? Because the cost of funding depends upon the risk exposure. If I'm your funder and I see the risk you are exposed to is immense, I have a reason to charge higher interest from you. Don't I deserve it? Well, I do. So in that case, so if we only focus on the company's value, company's potential performance, I think we are telling only one side of the story. The second side of the story is that how much risk you can potentially be exposed. Then we shall also find some metrics, some quantitative techniques, how to evaluate the risk factors. I said something in passing last week, that how you can see the riskiness of a company through the publicly available documents, but I will try my best that I should also train you how to do the calculations by yourself. Okay, that's my agenda. Yes, that's something which we shall do tomorrow. What is financing? What are the different sources of financing that we shall focus today? What is the ideal mix of financing? Look, financing is not unilateral. Financing is not homogeneous. Financing is not uniform. $1 you raise in equity and $1 you raise in debt, even though they look same, $1 is $1, yeah? But qualitatively, the $1 you raise in equity and the $1 you raise in debt are not same. They can have different implications and different repercussions on the company. So what should be the optimal mix of financing? So if you are presenting a finance plan and you're pitching it, which you will on 8th of March, then somebody can question you that, hey, what do you think, according to your company's fundamentals and the structure and everything, business proposition, what do you think is the optimum capital structure, and what kind of changes you may foresee in this optimal capital structure in the next 5 years. All right. Does altering the mixture of debt and equity can affect the company's value? Yes, it can. If you are getting too much of debt or if you're getting too much of equity, you can have an effect on the company's value. Isn't it ironical that companies' financing is on the liability side? Try to focus on the sentence that I'm going to speak. The company's financing is liability. Money comes. Then you start investing the money in assets. By that logic, the company's value should only be affected by the assets you have. Financing is only a mean. Financing is not an end. All right? But we shall also discuss that even you can be excellent company producing fantastic products, your machinery, your assets, all are great, but you can destroy the company. You can change the value of the company or even increase the value of the company with the financing mix. By having too much of debt or too much of equity can have effect on the company's valuation as well. So when, for example, you start the company and after some time you want to take a subsequent loan and you make a presentation that our company's debt to equity ratio is so much, all right, the amount of funding you may get can change depending upon the structure of it. And then what kind of right financing of a company is, well, no one size fit all basis. It will change from the company to company. The industry, the sector, and the firm characteristics also, and the business environment play a big role. It depends when you start your bank. You can be a great entrepreneur, but you started the business in the wrong time. You can be a very mediocre, very average kind of investor, or ripe when the best time was. So you struck hard at the right time. What is financing? Well, financing is the process of providing funds for business activities, making purchases or investing at various stages. The use of financing is, of course, vital for the economic and the corporate system, because if the companies don't get funding, then the economic system also gets shattered. Financial institutions such as banks are very major players who provide funding, but over the time, the more unorthodox or the non-traditional funding sources are really developing, and technology is really taking over the field of financial technology coming up. And at this moment, I would say that at least 4 students of mine doing research finance. That also determines what should be the right kind of financing. Yeah, basically funding helps the businesses to optimize their utility functions. By utility functions means things, the variables, the indicators, which gives you larger satisfaction. Okay. It's not only one factor which have an impact on your utility function. Okay. It's very important that you need to understand that what type of utility function your business has. Are you only going for revenue maximization? Is this gives you utility? Are you going for the profit motive only because you think that the products you make or the services you provide are high end, and because the life of the product, the service can be very short, and you don't make the mass products, but you make the class products, which only catering to the certain rich sections. Well, in that case, the profit motive should be try to make, don't try to sound too socialist. Try to make money as fast as possible before your product or service becomes obsolete, right? Before this life cycle is over. Are you going for the more market share? Do you want to capture the market? Is it what gives you more utility? Is it so that you want to be a cost cutter, that you don't want to care about the revenue, but you are very much, how to say, a very austerity kind of mission you have, that you want to bring down your average cost curves lower? And given the revenue, you leave the profit not to be decided by the more revenue, but by the falling cost. Are you very explorative? Are you going to try your product and services in the very unsailed shores, the markets which are hitherto before you were never tried? Are you very experimental? So what gives you utility? What gives you satisfaction? That is the business utility function. The point is that, do your investors also have the same utility function? Or do they think differently? Investors mean those who fund you, because for them financing is their investment. When they give you money, you show as a liability. But for the banker, the money that they give you is an asset. For them, it's an investment. So do you have the same, do your utility function, the business utility function and the investors utility function, does it coincide? Do they converge or diverge? It's very important. We come to the sources of financing, and as and when required, we can deviate from our discussion and bring some other related aspects as well. The first source of funding which I would like to share with you are called retained earnings. The retained earnings are also called undistributed profits. Remember, when a company earns revenue, it subtracts operating cost. Oh, sorry. So when a company has its total revenue, you minus operating cost, and that leaves you a profit. That leaves the profit for you. And any idea what that profit is called? If you have total revenue and you minus your operating expenses, so what is left? Operating profit. Very good. So you have the operating profit. Okay. May I ask you, when I say operating expenses, what are operating expenses? Don't give me the examples, but tell me as a concept, what are the operating costs of a company? As a concept, of course, we can give examples, but what is the concept of operating cost? Because I said that if a company's total revenue, apologies, I'm using these abbreviations, is 100, and your operating costs are, let's say, 50. And Fernando said that this will be called as operating profit. I totally agree. But my question is that, as a concept, what is meant by operating costs? So if I can say so, primarily, the operating cost includes the production cost for sure. But on top of the production cost, it also includes the selling cost. I'm not saying marketing cost in particular, I'm saying selling cost. And when you add the operating costs, when you add the production cost and the cost of selling, it becomes, there's a word called COGS. Cost of goods sold. All right. So primarily, your operating costs are cost of goods sold. All right. Let's say 30 are your production cost and 20 are your make the selling expenses. All right. Or the selling and admin expenses. So altogether 50 is the operating profit left over. Now from this profit, You pay what? The next category of expenses is called finance cost, which is primarily interest. Interest plus the installment of the loan due. Yeah, so that is called debt servicing. So this is called finance cost. All right, there could be some penalty interest rate also. It could be possible that you enjoyed the debt moratorium. Debt moratorium is that, I'm deliberately using these words because we use them in finance and I want you to know them. Sometimes I try to tease you with these words. There's a word called moratorium, debt moratorium. For instance, I borrowed from you, Fernando, 3 months ago. For the first month, I paid you interest. The loan I would pay you after 5 years, right? But then what happened last month, I requested you, Fernando, I don't have, there's some crunch going on. Can I pay you this month's installment along with the last month's installment together, right? Maybe on friendly basis, you can allow me this thing, but you see that there is a problem when I am repaying you, then you can say, Shab, I know you are having some problems in financing issues. I want to make your life easy. Don't repay me any installment for the next 7 months. Restructure yourself, reuse this money, but give me 0.5% interest extra after 7 months. So this period which you allow me not to repay you is a debt moratorium period. Okay, but when I start paying it, of course, I have to pay you for this, not only the existing agreed interest, but also this extra service fee. This is a facility you give me. I can even call it in the as a penal interest rate. The penalty interest rate. I can say so. All right. So this is the finance cost. Yeah. Let's say this finance cost is 10. So then we are left with the profit 40. This profit 40 is called, you can call it gross profit, profit before tax, or the earnings before tax. There are different phrases the accountants use, and when you have your legend company, it might use different phrases also. So this 40 is now. Yeah. No. Yeah. You're right. Exactly. And even the operating profit is of 2 types. I didn't classify. I tried to make it as simple as possible, but even the operating profit is of 2 types. One is called gross operating, not this gross profit, but the gross operating profit. That profit is, if I have to write it, is called EBITDA. It looks crazy. EBITDA. So EBIT is, I'm coming on that. So the EBITDA would be earnings before interest, tax, D for depreciation, and A for amortization. A for amortization. And I hope you know what is depreciation. Remember, we did one example also last week, straight line method and some other method. Without going too much, without taking you too much into accounting world, I can say that depreciation is the loss of value on the fixed assets, tangible assets, physical assets, seeable assets. If the same thing applies on the intangible, non-physical, non-seeable assets, we use the phrase amortization. The loss of value of furniture is depreciation, but the loss of the value of some R&D experiment or a formula or a software or the copyrights or the patent, if that loss goes on, it's called, I would call it amortization. So the only difference, for example, I gave you an example last week, GlaxoSmithKline developing a drug. right? Now the drug would become off patent in 20 years. After 20 years, it will be anybody can make it. So it means the working life of this patent is 20 years. But this every year which you diminish value will not be called depreciation, it will be called amortization. I can write it down. Not here. So if we have 40 gross profit, or as I said, it's a profit before tax or the earnings before tax, right? And let's say the tax is 10. Now what we have is 30. 30 can be called as net profit, profit after tax, or earnings after tax. This is a kind of disposable income. Now the company has no liability to share this money with anybody else. This money belongs to the company, hence to the shareholders of the company. But life never stops here. The company has to keep some reserve fund for the future unseen contingencies, unforeseen factors, or even foreseen factors. For example, 1 year could be when they say that, hey, you know what, this year we want to totally renovate our the office building, so we need money. So this year we will not give all the money to the shareholders. You get my point? So this entire net profit, it is of the company, hence it is of the entrepreneurs or the shareholders, but even the money which the company keeps with itself for the future growth or to meet the future challenges is called retained earnings. The retained earnings. So the company, the plain vanilla, the simple thing which company can utilize to finance its resources is that in the past years, the company has accumulated undistributed profit. So there's a rolled over period. So you have been saving some money. Let's say this situation remains same for the last 10 years. And every year, if you have net profit 30, you never give all money to the shareholders. You keep 10 as a retained earnings. It means if the situation has been same for the past 5 years, your retained earnings should be 10, 10, 10, 10, 50 as a bank account. And no, 10 I said retain, and 20 you give to the shareholders. Yeah. So if you imagine that you give 10, then by the end of 5 years, you would be having a retained earning of 50. And if your new investment is costing you 10, 20, 30, it's not a very whopping sum, but it still can put strain on your finances. Then with the retained savings, with the retained earnings, you can basically meet this expenditure without troubling anything, So it's like a very organic way of financing the company without borrowing or doing anything or asking anything here. Especially when you think that you are already in debt, and if you go for a fresh dose of debt, your funders would not be very happy with you. So in that, it's like an internal funding source for the moderate, for the medium-sized investments. Very right. It's an administrative, it's a managerial, or it's a leadership decision. It depends upon, for example, in the companies where you have one-time investment and you will not require to make any investment for the next 7, 8, 9 years. You are an oil company, you have done your oil rigs are established, they're installed in the sea. You will do nothing much for the next 4 or 5 years. So in that case, your retained earnings could be less. But for example, if you are in the tech business and the speed of obsolescence, the rate at which your technology become out of fashion is so fast that you would rather keep a big chunk as a retained earnings. Very good. Very good question. Imagine I'm a CEO of the company and I'm very growth oriented. I know that my company has a very promising future and I must have lots of money and I should rather save, you know. So the problem is that this 30 is now a bone of contention. Should it live with the company or should it be distributed with the shareholders? Obviously, if you are a shareholder of this company, the company I'm talking about, and I assume that you are having a very diverse portfolio, so you invested in many other companies also, then you will treat me as any other company. And at the end of the day, what you want is a dividend. So you may be pressing me, hey, why don't you give dividends? And I'm saying that, you know what, this money, if I share with you, then how would I bring this money, which I have to finance a big investment project in the next few months. And the company's success, survival depends upon that project a lot. And you say, I don't care. What will happen? At the most, the stock price will slightly go down. The moment it goes down, I can sell off. So it depends upon what type of shareholders you are. Huh? Yeah, that's right. That's right. Yeah. And even in the public companies, if you are a big institutional investor, if you're an individual investor that you buy today and sell after 2 hours, you are a very day trader kind. But if you are a big bank, or if you are a state investor, you know, some state organization has invested, they want to stay with the company for many, many years, right? Like we are working for a company here that's a private company. And that company has invested in many SMEs in central Finland. They have the fund, they recycle after 10 years. After 7 years of investment, then they start, hey, now it's time to exit. And the fund is not very big. The company it invests in are all SMEs or even startups. But even in that case, they keep 7 years time cycle. So it depends upon what type of investor you are. Mm-hmm. Bring the stock price as low as possible. Yeah. I mean, it was, I don't know why I didn't want to say. But do you remember last week I gave you an example that there was a survey conducted of top 100 Forbes companies, CFOs, and they were questioned that do you want to have a long-term investment, long-term growth of the company, or do you want that when you look for the long-term growth, you have to sacrifice the next quarter's profits? And 80% of them said that we don't give a damn to the company's long-term growth, but we can never sacrifice our 3-monthly profit. So that shows how short-termist. And I'm not talking about any company from a very flimsy or from any stock exchange. I'm talking about the top richest, the biggest, top 100 US companies, CFO's opinion. And CFO's opinion means basically the company's opinion, because they would never say against the company's view. Mm. Their income comes also from there. Mm-hmm. So from there, their price will affect their income, bigger or smaller. That's also why they might focus more on their price, stock price, in the stock exchange. Mm. That's one of the reasons why the companies are buying back the stock, because they still are feeding the more demand for those stocks, which will increase the market value. Yeah. In the same time, they are increasing your salary. Yeah. In a way. Yeah.
So also another thing now with public companies is instead of the stocks or the investors financing the companies actually are financing the investors with examples as you gave.
Mm-hmm.
They are financing investors through trying to increase the share price, but not necessarily getting more money in, but getting money out.
Yeah, yeah. Well, you said many important points, but what I would say that the stock price of the company can go up as well as down if you start sharing more money with the shareholders. If you are scared that, you know what, if I don't give dividend, I mean, if I don't share the profit with the shareholders, then they will follow the Wall Street walk phenomena, which means they start selling the shares. So I'm afraid of them leaving. If many big companies, many big investors in my company, shareholders, they start leaving it, it will put me in a real crunch. In that case, I have a reason not to undertake this very value additive, long-term, beautiful, fantastic project. I have a reason to sacrifice it because that is a future, that's futuristic. But the problem is that if I don't give money to my existing shareholders, they would leave the company and the company would be in real doldrums. The second option is that if the company has a growth orientation, then even the shareholders would ask, don't give us dividends, please. We don't want. Please, recycling it. So it depends upon the company, and it also depends upon how powerful the CEO is, how much the investors can challenge the CEO. Once again, I hope you remember last week I drew two pictures. One was of an American company and the other was of a German company. In the American company, the shareholdings are very liquid. So we use a phrase that if you then your share ownership is like this. We have large number of small shareholders. But if you are a typical German company, then your shareholding is like this. So in a typical German company, you have a small number of large shareholders, right? So the idea is that here, the CEO have more chance to go unchallenged because nobody is in an individual position powerful enough to challenge him. The role of institutional shareholders, yeah. The role of institutional shareholders in the US economy, in the US corporate sector is still very limited. Oh, here, oh my goodness. In European companies, I have sympathy for the CEOs of a European company. Because he could be in the board of directors, sitting in the corner and looking at like as the shareholders are fighting with one another, and he's watching the table tennis match. What's going on? Whereas in the typical US company, he's far upright, far assertive, and he can even, in a nice way, he can even bully. You get my point? And this is exactly the reason. See, your compensation depends upon how much power you exert. And that is why the American CEOs are far, far, far more paid than the typical European company CEO. Right? Some 10 years ago. Huh? Oh, yes, that's the one factor. And I tell you something. 10 years ago, a survey was made in Britain, in the US, all over that who are the top highest paid CEOs. It's an old survey, but still it went to my heart because it was such a the finding was so startling. Imagine all the CEOs are made to stand in a queue by the order of amount of salary they get. The first 94 were American. Yeah. The 95th was Sky Broadcasting CEO, Britain. And Britain structure is not typically European. It's like Anglo-Saxon. All right. And there was hardly any continental European CEO in the list. Okay. So, huh? Normal what? The normal worker. Well, it could be a few thousand times difference. Well, it can be even more. It depends who you compare with. But that's again, I'll be a little bit cautious in generalization that this type of problem, it's a governance issue, that who govern the company. This is called vertical corporate governance problem, where there can be a conflict between the principal, the manager, and the agent, the share. The agents are so scattered that it's very difficult for them to come and fight, make a proxy war. We use the word proxy war, where the shareholders, they pool their resources and they wage a war against to oust him or her. On the contrary, this is a horizontal governance problem. Here, there would be a clash between shareholders. There's an intra-investors conflict. What? The agenda, the priorities of the big institutional investors may come in conflict with the small minority individual shareholders. They think different, So, and these poor, they would be grinded. they are in a mixer grinder where they can be less heard of. Yeah. All right. So we also discussed some governance issues with this. It's always nice to have some discussion in the passing. So yes, so we have this one first source of financing called retained earnings. Very interesting. The second form of financing is called corporate debt. This debt is raised by the companies, and we use a word CPs for it, corporate papers or commercial papers. Okay. Once again, they can be bills, they can be bonds. Bills are for the short period. Bonds are for the longer period. And what is the benchmark? What is the cutoff line between the short period and long period? Is 365 days. In finance, anything below 365 days is a short period. But anything 365 days and above is a long period. Okay. So the corporate debt is one. The interest rate data you can see from the markets. The Euribor or the Libor is a benchmark, but of course you put some premium on top of it depending upon your credit worthiness. So the benchmark, the normal benchmark when the companies start borrowing, depend upon what is if you're a European company, how much is the Euribor, and how much the investors are putting premium on it. The risk premium, yeah. And based on that, so imagine it's a Finnish company, and the Euribor is minus 0.1%. Okay, but the investors who will be investing in your company, they don't consider you the safest company in the world. If they consider you the safest company, then all they require from you is minus 0.1%. But if you are not, which quite likely you will not be, then they would be adding the risk premium. Imagine you are a ABB company, yeah, according to Moody's S&P list or whatever, and they put 4% premium. And if you do this, it comes to 3 point. Then the cost of borrowing would be 3.9%. Okay. Tomorrow, when I give you the real life company case, I would assume that my benchmark company, I would assume tomorrow that I'm going to start a business with 100,000 euros in the oil company. And I would assume that my benchmark, my legend company is BP. All right. So I would do the calculation in the context of BP. I hope you remember that in the real life, when you do the comparative company analysis, your minimum number of benchmarks, which I reckon should be 5. Anything above 5 is welcome. Okay. But because it's only an exercise, so I would only ask you to choose one legend company. Enough. So tomorrow, my legend company will be BP, British Petroleum. Of course, we pay interest to the loan. But here I think, and the interest you pay, as I said, the interest you pay is calculated like this. Okay. And I will also discuss with you how you can calculate the interest of your company's expenditure through the financial statements. Okay. But then I thought that I should slightly, in tangent, I should discuss with you that the yield to maturity is something which matter to investors more than the rate of interest. The yield to maturity concept comes in the picture when your debt is also tradable like stocks. In many countries, I can give you example of India and Malaysia. In India and Malaysia, you can get the financing from the normal source, debt and equity. Yeah. Of course, for equity, there are stock exchanges. Like if I give you example of India, India has 2 stock exchanges. And India has the highest number of listed companies in the world. And in terms of value and size, it's 7th or 8th. Okay. But there is a catch. There is no real stock, I shouldn't say stock, there's no real exchange for debt trading. Company issues equity, they are tradable. Companies, the corporate, they issue debt, that is almost untradable. There's no real market where you can trade the debt. But in many countries, including Finland, including all the major economies, the debt is also tradable. For example, I lend money to you, all right? And the deal is that I lend you 100 euros. And the deal is that the interest rate is 2%. Okay? And your company enjoy a lot of reputation in the market. And just when I lent money to you, you gave me the piece of paper or even the DMAT in my computer. There are some people outside who are desperate to give you loan because there's so much trust you. They really like you, that, hey, this company is great, fantastic cash flow, and they are even offering high interest rate. Then somebody asked me, hey, would you like to sell the debt to me? And they asked me how much money I give you. I say, I give you 100. And they would say, take 110 from me. Sell the debt to me. So I take 110 from him. Now the debt is owned by buy from me, but I sell the debt. Look, I gave you the money. The piece of paper is with me, which says I owe you. This piece of paper I sell to somebody, 110 euros, and I walk off. Now this, of course, why not? Why should I sell at lower then? Well, the rest of the market is giving them 0.5%, and this gentleman is giving 2%. And there's also a possibility that if they stay with the company for 5 years or 2 years, let me finish. If they stay with the company for 2 years, their debt can be converted to equity.
Okay, maybe not. You pay 110 to maybe how is the company bankrupt? Then the people look if they're not with 100. That's what you will find out.
Okay, can I say that I lent you 100 and I sold it for 102? Can I change the figures? Not maybe too, not too exaggerated. No, he has debt. No. You're missing the story. Let me reconstruct. I lend you money, 100. All right. So you gave me 2%. It means that after 1 year, I'll get more than 100 from you. Yeah. Okay. But when I go out, or when I go in the secondary market, there is somebody who likes his company so much that they're willing to pay me 102. That, hey, you get aside, give us your paper, we pay you 102. The paper's value is 100. But the market, the face value is 100, but the market value is 102, 103, whatever. Now they would take money from you, but you will not give them 2% on 103 they gave to me. You still give them because you don't even know what is going on. It's a secondary market transaction. So there is a possibility of debt getting traded, like stock getting traded. Like, for example, if I replace this example by shares, for example, you issue an IPO and I buy your company's shares for 100. After 2 hours, the price goes up. I sell in the market, simple, walk off. No, it's a legal transaction. Of course, we can, I know, yeah, but we can link it with money laundering in many ways. If we want to make some connection, of course we can. But now what happened? That my whole idea was that the countries, the financial system where debt is tradable, debt will have 2 values. Like the stock price. Stock price has a book value and the market value. Face value and the market value. Face value or the present value. I'm using different phrase for the same thing. The same thing would apply to the debt. In that case, what matters to investor is not interest, but yield to maturity. Because if this piece of paper you give me is for 5 years, then it may change during this 5-year period when when you recall finally your loan, hey, time up, finally, debt over. During this 5 years, there can be 10 or 100 or 1,000 people who this piece of paper is changing hands. All right. It means that if somebody buy the piece of paper after 2 years and sell after 2.5 years, that fellow would be paid for 6 months. All right. Then the annual rate of interest doesn't matter. What matters is yield to maturity. Okay. Yield to maturity matters to those debt which have a market value as well. Okay. Now, time has come when I show you this example, and this file is here in spreadsheets in Optima. So you go to the study material and you find the spreadsheets, and there we go. Yeah, maybe I make it slightly larger. I hope this is sharing. Yeah, I'm sharing it. Now, what happens here? I will also show you that if there is no market value, So there's only both. Let's say there is an Indian or Malaysian style debt market, then there's no difference between yield to maturity and the interest rate. All right. Okay, let's say the face value of the debt is 1,000. And I'm just playing with the numbers. The market value of the debt has gone down. So over the time, the company's debt, the company's reputation has gone down or whatever has, just opposite to what I was telling in your case. The market value has gone down. The maturity is still 10 years. The coupon rate means what is written on the piece of paper is 8%. Then definitely, I will call what this as a FV, means a face value. 890 is a present value, the current market price. And I call it minus because this is how much you pay. So you pay 890 to get the debt of 1,000. It could be that your market, you're not doing well in the market. It could be even more than 1,000. Like in your case, it was more than 100, so more than 1,000. Let's say the number of periods are 20. Why 20? Because I assume that the interest will be paid after every 6 months. So during this 10 years, there are 20 periods. Generally, the interest rate is calculated after 6 months, not for the full year, but after 6 months. And let's say this is a calculation, yeah? So it means that there are 20 periods, and for each period, the interest you get in monetary unit will be 40. How? 8% on 1,000 is 80, yeah? But because it's 2 times a year, so it will be half of 80, which means 40. Make sense? And then we use the spreadsheet function, and the function is called rate. Rate H6. Well, H6 is what? Time period. H7, the amount you get. H5, the amount you invest. H4, the face value. You can see it's written here. Number of periods. When you use this function, rate function, you can find that your 6 monthly yield to maturity is 4.87. And if you double it, because we need to find for the full year, that is the 9.75, basically. It means that even though the coupon rate is 8%, the actual rate which investors become richer or poorer by is 9.75. Remember, last week, again in a quick succession, I made a generalization that the assets market value and the rate of interest have a negative relationship. Assets market value and the rate of interest has a negative association. I can prove it here. By the way, this is also rate of interest. We just call it differently. It's again a rate of interest. Exactly. Now imagine you invest 1,000 euros in a security, yeah? The rate of interest is 10%. Let's keep it simple. It means you will be getting how much? 100. Now imagine the rate of interest jumps to 12.5%. Okay? To get 100 euros, you don't have to invest 1,000. We need to invest 800. It means that that asset which you bought at 1,000 when the rate of interest was 10%, when the rate of interest goes to 12.5%, the asset's market value would shrink. And this also proves here. I just said other way around, but basically it still shows that when the rate of interest was 8, the face value, or even that time, let's say that the whole value face and the market value was 1,000. But when this goes up, then the market value goes down. So I'm just saying the same thing, but in a different direction. I said something that in a country where there is no secondary market for debt, in those countries, the face value and the market value remain same. Am I right? Because there's no secondary market. So imagine that this remains same. You bought something. Please listen to me carefully. You lent something to, in this case, okay, I lent you 1,000, and I would remain eternally your debt holder because I will not be able to sell it to somebody else. It means the market value doesn't matter because there's no market. And imagine that this value would never change because I will not sell it to anybody else. So this also remain 1,000. Yeah, because there's no market value. So you just get what? There's no change. So that it means that this 8% wouldn't, in a country, in a system, because after all, your new venture would be in some system. In a system where there is no secondary market of debt, where you cannot sell and buy debt as you can sell and buy the stocks. There's no difference between the rate of interest and the yield to maturity. In fact, the yield to maturity word itself is a misfit. It doesn't work, just interest rate. But in the countries where there is a secondary market, so there is a chance that the market value of the debt would change, then what matters you as an investor is YTM rather than the interest rate, because many people would board in, board off during this 5 years. Hmm. Types of debt issued by companies. Well, they are secured. Very simple to say. I mean, secure is fully collateralized. You know collateral? You know what is collateral? Collateral is a security which you deposit. So, for example, when you buy in Finland, when you buy a mortgage, when you buy a house, and this house is financed by debt. All right. So when you buy the house, you make a deal. You have the housing paper. The housing paper are with the bank, and the bank gives you loan. So it means that in case you can't pay the loan, you default. The bank's loan is fully secured because your house papers are there. In many cases, if you take a loan against your project, then the project registration paper, after all, you start your business. You start your company registered with the local city council or whatever. So that piece of paper or those permissions, the license which you get would stick with the bank as a collateral. And the pecking order of claimants is very important. When a company takes a debt and takes debt from multiple sources, all right? So there is also an element of juniority and seniority. So there are some senior lenders and the junior lenders, and they are in the pecking order. The pecking order is, well, I think it's nice to introduce you with another word. It's called covenant. Covenants. The debt covenants. The debt covenants basically are that if you borrow debt, if you take debt, if you take a loan from someone, you have to follow certain rules about the debt. You have a agreement, and often the agreement says, in case of debt, is that if you are borrowing in not from the friend or a family, but from outside source, that in the pecking order, the first claim is of the state. So if you owe some money to the government, it will have the first claim, and then it could be the second claim could be of maybe employees, depending upon how well employees are positioned, and then the debt holders. And among the debt holders, the one who gives you the loan initially, whose debt is secured. Not everybody's debt is secure. Normally, if your debt is collateralized, the interest rate is low. And if the debt is less partially collateralized or completely unsecured, then the interest rate is high. So those debt which are collateralized, means secured, have a likelihood to have low interest rate, and the one which are non-collateralized or partially collateralized have a high rate of interest. Any logic or any rationale behind? You think I should let you have some coffee? Because some of you feel tired. All right. So what time is now? 4:30. So 15 minutes break, 15, 20 minutes break. Yeah. Okay. Yeah. But tomorrow's session could be a little bit, how to say it? I might use more time because tomorrow I have to really say everything in the context of your finance plan. Okay. So let's meet in 15 minutes. Take some cup of coffee and then we continue. Pause it. Maybe I can have multiple parts, so I can actually end it. I can read.